So in this video, I'm going to be talking to you about where exactly is the money made in QLA model. Okay, so QLA model is based on buying businesses, how to create wealth through acquiring companies which are already established in the market, that are producing millions of dollars in revenue and that have big profit margins. And you have an industry which has a lot of businesses, thousands and thousands of businesses that are available for you to buy, okay, and initiate that conversation to buy them. So the whole QLA model is based on buying multi-million dollar companies and selling them, combining them together and then selling them. Okay, so that's as simple as that. You are buying several small companies and you're creating a big company out of that and then selling it to a strategic player who wants to buy a big sized company. Okay, so that's what the whole model is based on, and I'm going to tell you where exactly the money is made. So there are a couple of areas where the money will be made. Number one is when you acquire a company, typically you will be raising financing from the bank to pay for the purchase price. Meaning you reach out to a seller, you negotiate the price, you have agreed on a price, and you need to come up with the money that you have promised to the seller from the bank. Once you negotiate the price, you go to the bank and you get financing to pay to the seller, kind of like a real estate mortgage, right? So when you raise money, let's say the business costs around $1 million. Again, depending on the structure of the deal, you can raise $1.2 million instead of $1 million. You raise a little bit extra and you justify this $200,000 as the closing costs. You have to declare it with the bank that this is going to be closing costs to pay your lawyers, your accountants, etc., and also to your company for the work that you did. So you can justify this as a closing costs, and you will have $200,000 extra in the transaction. You have to declare it. If you don't declare it, that would be bank fraud. So you need to make sure you declare it to the bank, and you need to make sure you have a financial professional and a legal professional advising you on this transaction. I'm not going to get into how to get these people, but I'm just telling you where the money is made. So you've got $200,000 extra in the transaction. Out of this $100,000 most likely will go to your lawyers and accountants to pay their fees, and you will have an additional $100,000. Using this $100,000 on this transaction, you can pay yourself and your board members bonuses. Okay, so that's one area where you will make the money, is the bonuses. The second area is when you acquire $1 million business, you will have income from that business, but most of that income is going to go towards servicing the debt. So let's say your yearly payment is to the bank is $100,000, but the business is producing $200,000. So if the business is producing $200,000 and your payment is $100,000 to the bank, you will still have $100,000 left in the company. Out of this extra $100,000 that's remaining in the company, which will be your profit, the bank is going to not allow you to extract this money fully. So what you can do, because the bank will want to keep this extra $100,000 as a security. If you have a bad month, if you have a dry month where you cannot, your cash flow is limited, so the bank can recoup their payment from this extra $100,000 that you have left in the bank account in the company. It's basically frozen. So what you can do is you can tell the bank, you can extract a salary instead of giving yourself profit, extracting a dividend. You pay yourself a salary. Okay, so that's the second source of income, is when you buy a business, you pay yourself as a salary. You show yourself as an employee, or you can have a management contract forming another company. This company has a management contract with the company you are acquiring, and this company is paying this company a consulting fees. Okay, so that's an income, an additional income that you can get from your acquisition. So number one is bonus. Number two is the salary or consulting fees that you can charge to the business you acquired and pay yourself from that. So this will be enough for you to pay your bills. Okay, this is not going to be some extravagant amount because most of your wealth is in this business. It's locked in the business. You will not have a lot of cash. So you will have enough money to pay your expenses, but you will not have enough money, for example, to buy a Ferrari, especially on your first deal. So once you start doing multiple deals, and once you are extracting a little bit salary or a little bit fees from each business, that's when this fees is going to start accumulating. Using this fees, you will need to hire employees like CEO, COO, a general manager who will be managing these companies for you, managing your portfolio, and you are a full-time employee in the company also. So you will be paying yourself a salary also. Now your salary is going to be very nice salary. Once again, it's not going to be in tens of millions of dollars, but it's going to be a couple of $100,000 as a salary. The purpose of the salary is just to pay your bills and live comfortably. Okay, the purpose of the salary is not to drain the company and pull out a whole bunch of money up front. You don't want to do that. And I'll get into why that is, but you pay yourself a salary enough to pay your bills. If you have really a lot of surplus cash, it's better to use this cash to buy bigger companies. Okay, to keep buying companies. It's important that you take what you need and the rest you roll it over into transactions, because using that money you can do $5 million, $10 million transactions. So why would you extract this money where you can, if you can use it to multiply your wealth and make the company bigger? The whole intention of this entire business model is to create a company big enough so that you can exit. Most of the money is going to be made at the exit. 5 years, 7 years from now, once your portfolio is big enough size, you will take this company either public or you will sell it to another investment company. This is the time where you will receive the big check. Let's say your company, you acquired, 10 companies and they are worth, you paid $50 million from the banks to acquire these companies, and you are selling them, these companies, at $100 to $150 million. Okay, so out of this $150 million, you will still have some debt portion remaining that you have to pay to the bank. So you can pay that to the bank, okay, and then you will have to pay some tax. Okay, then you will pay the tax, and then you would be paying your board members from this capital gain that you received. You pay the board members, and then you have a fortune for yourself that you will have for yourself. So, and about how to reduce your taxes and etc., your lawyers, your accountants will help you structure your company legally in a way so you can reduce taxes legally and benefit from this. So number one is going to be your bonuses on every acquisition that you do. And the minimum size of the acquisition is going to be $1 million. That's the minimum ticket size. So on every acquisition that you do, you can pay yourself a bonus from the transaction. Some transactions you will be able to pay yourself a bonus. Some transaction the bank will not accept it and you will not be able to pay yourself a bonus. So one thing is the bonus. Second thing is the salary that you draw from the business. Okay, and this is something you will factor in the cash flow. And the third thing is that when you create the whole portfolio and when you sell the whole portfolio at a 2-3 times price, that's the time where you will make a whole bunch of money. So around 5 to 7 years, you are living comfortably and most of your wealth is locked into your asset. But once you sell the asset, that's when you will have a whole bunch of money that you will make. So these are the areas where you will be making money in your company.